Government and Nonprofit Accounting, Chapter 5. Chapter 5 focuses on capital budgeting and capital asset management. So our capital assets are, of course, land, buildings, machinery, equipment, and then works of art, historical treasures, infrastructure, assets such as sidewalks, roads, bridges, and then intangible assets. Our capital budgets are often financed by the issuance of long-term debt that gets repaid from a variety of sources, such as tax revenues, special assessments against property, grants, transfers from other funds, financial gifts and contributions. We can lease or a combination of all of these resources. So of course, GASB requires that we log capital assets. We have accounting rules for capital assets. We generally create capital project funds for construction and major capital expenditures. And in the general fund and special revenue funds, we have to account for the capital outlay of expenditures from budget appropriations. Often, cities have capital budget plans where they plan ahead for major expenditures so they can start saving money for those expenditures through taxes and different amounts, or they can plan debt service such as bonds. Our governmental-wide government activities account for the cost and depreciation of general capital assets. So remember that depreciation expense is only reported in the governmental activities ledger. So things that we have to disclose about capital assets. So one of those things is capital assets that are not being depreciated. So governments can make choices to not depreciate certain items. If they are not depreciating those items, as you'll read in your text, then they have to give reasons for why they're not depreciating the assets. They have to put notes in the financial statements about how they are maintaining those assets and keeping those current. We also have, beginning of year and end of year balances showing accumulated depreciation, any capital acquisitions that occurred during the year, and then any sales or dispositions of assets during the year. We have to disclose if we have items that are not capitalized and explain why they're not capitalized. So in addition to not depreciating items, governments can choose not to capitalize certain items such as art or historical treasures. They're not required to capitalize them if they're like on permanent display or for educational purposes. But if they choose not to capitalize them, then they have to explain that they have these collections that are not capitalized and why they decided not to capitalize them. Okay, so we have, of course, a variety of assets. So land, as we know, land is not depreciated. And the recorded value of that land, so that historical value that we're required to put, depends on how the asset is required. So if we purchase the land, then it's the contract price and all related costs. Since government purchases will sometimes include lawsuits, either trying to stop the sale or eminent domain issues, we can include all lawsuit costs into that all related costs. Forfeiture. So this is people have abandoned their land, people didn't purchase land but then didn't pay any property taxes on it or other things like that, so it gets surrendered. And of course then we can include the total amount of all back taxes, any liens on the property, and then any legal costs that we've had to include for acquiring ownership. And then donation. Somebody can donate us land, and that is recorded at the acquisition value on the date of donation. Okay, buildings. So buildings, building improvements, and land improvements. So we know buildings, if we build buildings, major building improvements such as installing air conditioning or elevators into old buildings, different things like that, major repair, and land improvements such as parking lots, lights, fences, etc. All are depreciated except land improvements that are inexhaustible. So sometimes we do improvements to the land that provide permanent benefits, such as leveling the land, or that's a really good example, like leveling the land. Okay, recorded value, very similar to land. If it's purchased, it's the price and all related cost. If it's constructed, it's the cost of construction and related cost. And if it's donated, it's the acquisition value on the date of donation. Okay. Machinery and equipment can be purchased, but they can also be required through construction or donation. And the valuation rules are exactly the same as the building rules. Machinery and equipment are depreciated annually. Okay. Then construction work in progress. So in our governmental activities general journal, we would have an account, construction work in process, to capitalize the accumulated costs of a construction account. We would also start a separate capital projects account for each construction project to keep track of it. In the general activities journal, we're going to, report what is the current value of that asset as it's being built, so those costs. And then when the construction's complete, we reclassify the asset to the appropriate category. So it's infrastructure, we were building roads or a bridge. We were putting in new sewer for a land development, so things like that, where the city owns the sewer pipes underneath people's land to get sewer and water to their houses, in addition to roads and bridges and other types of infrastructure. So our infrastructure assets, like we talked about, highways, streets, sidewalks, storm drainage systems, water pipes, sewer pipes, things that can be preserved for a longer life. These assets are depreciated unless the government adopts the modified approach. If they adopt the modified approach, then they have to disclose that in the financial statements and state why they used a modified approach and how they are accounting for that, for the maintenance and care of that asset. Okay, so this modified approach, a government can elect not to depreciate certain eligible infrastructure assets as long as they meet these two requirements, as I said, which is an inventory of these assets, the condition, and then how they are being preserved and cared for. So the documentation needs to be included in the notes to the financial statements. Intangible assets, these are very similar to intangible assets for business entities, where we have trademarks, copyrights, etc. So capital assets that lack physical substance. They have a useful life of more than one reporting period and are non-financial in nature, such as a patent that has a 20-year useful life, or a copyright, which its useful life is 100 years plus the life of the creator. And then we have leases. So if we lease, we have specific rules, and because you've taken intermediate, that businesses have specific rules for leases also. So of course, a lease is where we are using something temporarily for purchase. If it's a short-term lease, it needs to be 12 months or less. Otherwise, it's a long-term lease. Leases are recorded as expenditures of the period. They do not get listed as capital assets, except at the government-wide level, where we have a lease liability and then an intangible right to use lease asset. So that's just for the life of that lease contract, we would have this right to use lease. Any costs that we incur after acquisition of an asset, so this is comparing to that expenditure or revenue. So this goes back to actually Principles 1, very similar concepts, where if we spend money that adds to the utility, function, useful life, it gets capitalized. Otherwise, they are expenses in the period. Okay. Then reduction of cost or asset disposal. So if we have asset impairment, a tornado comes through, or so an asset is destroyed, or we get water damage from a storm, different things like that. So of course, when we dispose of it, then we remove the cost of the asset and accumulated depreciation from our general ledger, and then we recognize a gain or loss. If we are just reducing the historical cost of that, so that just requires so in the act where it's destroyed or something happens to it, a major impairment, that we would record entries to reduce the value and the accumulated depreciation associated with that. So these asset impairments, and then if we have insurance recovery on it, so if we have our building has insurance, it gets hit by a tornado, then we would write down the asset's carrying value, and we would have to record any loss or gain net of insurance recoveries and disposal of the asset. Okay, we have 3 different approaches for it, which is the restoration cost approach, the service units approach, and then the deflated depreciation replacement cost. So when we're looking at those options, it is how we account for those, how we account for the fact that we had insurance issues and we had an asset impairment. Okay, so then we also have service concession arrangements. So under service concession arrangements, the government transfers the rights and obligations of an asset. So this can be like the government still owns the building, but they have somebody else managing the building and the services, and everything collecting fees, etc., like that, and then transferring those to the government. We have to, if we have a transferred asset, we have to continue reporting that transferred asset as a capital asset, and then any related contractual obligations as liabilities. So for example, if we've contracted with like the YMCA, so we have this city building that the YMCA has come in and started using. They're offering services to the public as part of the YWCA. We have an agreement with them that they collect